Howdy, y'all. Welcome back. It's the weekly economic update for the week of 9/6 or September 6th, 2021. It's actually Tuesday morning. Yesterday was a holiday and got all my correspondence set up on the website, but didn't get a chance to shoot in a video. Hope everyone had a fantastic holiday weekend. It's pretty nice here in Colorado. We had some pretty pleasant weather. It's beautiful and sunny outside. I'd show you on my camera, but it'd get wobbly everywhere. So a little stuffy today. Unfortunately, with the beautiful weather here in the mountains, it brings pollen and dust. And me and the wife have been sneezing all weekend. So hope everyone's sinuses are doing better than mine. So, all right, well, let's go ahead and jump into the weekly update. So, all right, starting out. Week on Wall Street, stocks were mixed last week amid conflicting economic data and continued spread of the Delta variant infections. The Dow Jones Industrial Average slipped 0.24. The S&P 500 tracked 0.58, so slightly up. The NASDAQ was up 1.55, and international gained 1.51. Mixed market. Investors gravitated towards high growth technology and communication services sectors, as well as more defensive sectors such as utilities and real estate. Reopening stocks were weighed down by Delta variant fears and a retreating consumer, while energy struggled to bounce in the wake of Hurricane Ida, shutting down energy production and refining capacity. Stocks appeared to shrug off a shaky employment report on Friday, despite the questions it raised about economic growth in the months ahead. So that economic report, or the employment report, I think was only like 200 and something jobs added for the month of August. And I know that was a bit of a downer for those who were looking for another good report like we had in July. All right, mixed employment. After initial jobless claims reached a new pandemic low on Thursday, the August employment report came on Friday. It came in below expectations as payrolls expanded by 235,000. Adding to the subdued report was a 4% decline in the number of hours worked by employees. On the positive side, the Friday report showed that the unemployment rate fell to 5.2%, while wage growth rose 0.6% from July and increased 4.3% from August of 2020. So, kind of good and bad. And we talked about this on Friday. It seems like the people who guesstimate where these numbers are going to come in, they seem to be way off quite a bit. The weak report may reflect a pause in hiring due to the Delta variant. It could additionally muddy the outlook for the Federal Reserve, which has indicated it may begin tapering before year end. The uncertain jobs picture may force the Fed to push its tapering start date to 2022. All right, so economic data this week. Wednesday, we have the JOLTS, Job Openings and Labor Turnover Survey. Thursday, we have jobless claims. This week, we have a few companies reporting earnings. Today is Coupa Software and UiPath. Tomorrow, Wednesday is Lululemon and GameStop. Thursday, Zscaler and Affirm Holdings. And Friday, my first employer ever, Kroger. So, all right, well, let's go over to the monthly update. Some of this data is a little old, but we'll go ahead and jam through this real quick. Signs of an improving labor market, strong corporate earnings, and more clarity from the Fed on tapering plans propelled stocks to multiple record highs during August. The Dow Jones was up 1.22%, the S&P was up 2.9%, and the NASDAQ was up 4%. Corporate earnings were good. Corporate profits in the second quarter were by all measures exceptional, with 98% of companies in the S&P 500 reporting. 89% beat Wall Street consensus estimates by an average of 17.7%. Companies posted an earnings per share growth of nearly 92% over the second quarter of 2020. But, I mean, you have to kind of look at that. The second quarter of last year sucked. I mean, it was pretty terrible because everything kind of shut down for whether or not it was just a few weeks or a few months, depending upon the area that you lived in. The labor market also showed signs of improving health, providing evidence that the economic recovery remained intact. In August, jobless claims reached a pandemic low, while employers added 953,000 jobs in July, and job openings reached record levels. The Fed has been at center stage in the final days of trading. Fed Chair Jerome Powell stated that the Fed may begin to pare back its monthly bond purchases before year end. Powell Powell's updated followed multiple comments from regional Federal Reserve Bank presidents indicating their support for reducing bond purchasing. It's important to note that Powell said that tapering should not be seen as an indicator of future changes in interest rates. Yeah, well, we'll see. All right. So as far as the sector scorecard, for the second straight month, energy was the only industry sector under pressure. Energy lost 1.34% in August. Otherwise, gains were posted in communications, 3.52, consumer discretionary, 1.54 up, consumer staples up 0.83, financials up 5.28, healthcare up 2.45, industrials up 1.39, materials up 2.19, real estate up 2.20, technology up 4.1, and utilities up 4.02. All right, what investors may be talking about in September? Since the early days of the pandemic, Fed Chair Jerome Powell has maintained that accommodative monetary policies will remain unchanged until the economy recovered. We'll see when that happens. He's been clear that the Fed would be very transparent in communicating monetary policy changes well ahead of implementing them to allow capital markets sufficient time to digest any change. We'll see. I mean, this has been talked about. I mean, many of the Fed chair or board presidents want to start reducing the amount of bond purchasing and also start increasing interest rates. All righty. And then world markets, a strong U.S. Market helped push international stocks higher with the MSCI index up 1.60%. That's for international stocks. In Europe, Germany tacked on 1.87%. The UK added 1.24%, and France was up 1.02%. The Pacific Rim was mixed. Japan rose 2.95%, Australia up 1.92%, but China's Hang Seng Index and Korea's, I can't even say that, edged lower. All righty. Let's go ahead and jump over to a couple of the white papers that are going out this week. The first one is titled "The Need for Power of Attorney." The point of a power of attorney is a legal instrument that delegates an individual's legal authority to another person. If an individual is incapacitated, the POA assigns a trusted party to make decisions on his or her behalf. There are non-durable, springing, and durable powers of attorney. A non-durable power of attorney often comes into play in real estate transactions or when someone elects to delegate their financial affairs to an assignee during an extended absence. A springing power of attorney springs into effect when a specific event occurs, usually an illness or a disability affecting an individual. A durable power of attorney allows an assignee or agent to act on behalf of a second party or principal, even after the principal is not mentally competent or physically able to make decisions. Once a principal signs or executes a durable power of attorney, it may be used immediately until it is either revoked by the principal or the principal dies. So what the POA allows in financial terms, financially, a power of attorney is a tremendous useful instrument. An agent can pay bills, write checks, make investment decisions, buy or sell real estate or other hard assets, sign contracts, file taxes, and even arrange the distribution of retirement benefits. Advanced healthcare directives, HCPOAs, and living wills. Some illnesses can even eventually rob people of the ability to articulate their wishes. This is the major reason why people opt for a healthcare power of attorney or a living will. There are differences between the two. A healthcare power of attorney, also called a healthcare proxy, allows an agent to make medical decisions for a principal should they become physically or mentally incapacitated. A living will gives an assignee similar powers of decision, but this advanced direction only applies when someone faces certain death. The assignee has the ability to carry out the wishes of the incapacitated party. So, interesting stuff. So I definitely recommend having some of these legal documents either prepared or on file so that, if something does happen, you don't have to jump through hoops and go to court and have, something done at the last minute. All right. The FAFSA Simplification Act. Learn how legislative changes can help you finance your loved one's education. All right. So it starts out as a grandparent, firsthand the challenges of funding a child's education. The free application for federal student aid, the FAFSA Act, was passed at the end of 2020 and has changed some of the qualifications for students to receive financial aid. These changes will affect those applying for financial aid for the 2024 and 2025 school year. You'll notice these changes on October 1 of 2023 when the FAFSA opens for that school year. One of the most confusing parts of the FAFSA process was how to account for cash funding. While FAFSA doesn't require 529 accounts owned by grandparents to be disclosed, families are required to disclose cash support that student receives. This cash support may then include money from a 529 account. If students receive money from these accounts, the student was still expected to disclose these distributions as cash, and very often financial aid needs and options were reduced. Parent-owned 529 plans are automatically factored in the FAFSA when a dependent files and are only evaluated for up to 5.64% available for college use. A 529 plan is a college savings. Oh, we know what a 529 is. It's like an IRA for college. So what have they done? They've simplified the questionnaire. The FAFSA has greatly reduced in size from 108 demographic, educational, and identification questions to a maximum of 36. Part of the restructuring was aimed to clear up confusion as to who is and is not a dependent student and what type of assets need to be included. Part of the questionnaire changes are due to changes made to the calculations for financial aid. The student aid indicator is the math behind the scenes that determines what types of funding and how much a student is eligible for. Keep in mind these calculations are still complicated, but that overall eligibility for financial aid has broadened. I personally wouldn't spend a lot of money sending a kid off to college unless they were going to be a doctor or an engineer, but that's just me. All right, reevaluate your work-life balance this Labor Day. It's kind of fluff. Talks about how Labor Day was created on September 5th, 1882 in New York City in accordance with the Central Labor Union. So I'd like to see more of an entrepreneur day. I mean, not that labor, the common labor doesn't do a lot of work. They do. But people seem to crap on the entrepreneur. I mean, the entrepreneur's putting his time, or she, putting their time, their trouble, and their capital at risk. And, most entrepreneurs go belly up. I think it's 7 or 8 out of 10 businesses fail in the first year. You could look up that statistic. It's not too hard to find, but I'd like to see more praise for those who create businesses rather than crapping on those folks. All right. Could a custodial IRA help young adults buy homes? So what this article goes into is, how to use some of the tax advantage vehicles that we have out there for things that aren't, the norm. Would you think to use your IRA or an IRA to buy a house? All right. Individual retirement accounts are for retirement savings, right? Absolutely. It is. Is that their only purpose? Not necessarily. Imagine using your IRA not only to save, but to facilitate a home purchase. This would obviously be a tall order for an adult given current home values, yearly IRA contribution limits, and the priority of amassing retirement savings. How about for a child, though? Could an IRA help them out? This thought has led some families to open custodial IRAs. You can start a Roth IRA on behalf of your child as long as the child has earned income. This is income from either W-2 or some kind of self-employment. The IRA belongs to the child, but until the child becomes an adult, you or some other adult can act as the IRA's custodian. The annual contribution limit for a Roth is $6,000. Say your kid has made $4,000 from freelance web design, or serving up lattes at the local coffee house, or working at your business. All $4,000 could go into an IRA. That might not be the case, but whatever amount it may benefit compound into over the next several years. Gosh, whoever wrote this is terrible. You might want to consider this possible use for a Roth IRA. What about taxes when you take money out? After-tax dollars go into a Roth IRA, and if the account is at least 5 years old, up to $10,000 of the account balance, including earnings, may be withdrawn without taxes as long as the withdrawn amount is used for a home purchase and the IRA has not bought a home in the last 2 years. In doing this, you can avoid the 10% tax penalty that normally comes when taking assets out of a Roth IRA before 59 and a half. So good news. So there are some other alternatives to freeing up some capital so that you can purchase a house. So, all right. And then I had one article that I did want to read through. I know if you've been paying attention to what's going on in the financial markets and in the economy, we've seen a lot of talk about the big asset managers buying up properties by the thousands. So this one is it's a couple months old. It was from June 11th of this year. It's titled "Corporations like Blackrock are buying up thousands of houses, pricing Americans out of the market. All right, so starts out. According to a recent report from the Wall Street Journal, roughly 200 investment firms are buying up tens of thousands of homes and sometimes entire neighborhoods, raising prices and competing with middle-class Americans looking to take advantage of low interest rates and buy their first home. In January, D.R. Horton, Inc. purchased an entire subdivision in Conroe, Texas, built 124 homes, and then put the entire neighborhood on the block. The winning bid for $32 million came from Fundrise LLC, an online real estate investing platform that lets you invest in commercial real estate through a real estate investment trust. A combination of investors swooping up single-family homes to rent out or flip, some of the lowest interest rates in history, and a housing shortage have caused home prices to surge, pricing normal people out of being able to purchase their first home. Over the past several months, investors have made up around 25% of home purchases. Home prices rose double digits in 2020 and are expected to climb another 12% this year, 2021. The bubble is reminiscent of 2004 and 5 prior to the housing crash, although this bubble is a bit different. After the 2008 financial crisis, investors snapped up tens of thousands of foreclosed homes and rented them out. After testing his plan on 3 different houses in 3 different markets, billionaire B. Wayne Hughes dispatched deputies to buy tens of thousands of more across the United States. Hughes' company, American Homes for Rent, now owns about 53,000 suburban homes in 22 states and collects about $1 billion in annual rent from said tenants. His plan paid off big. While millions of Americans were underwater, owning more on their mortgage than their homes were worth, investors accounted for about 1/3 of sales in many markets. After the crash, the government incentivized Wall Street to step in where the individual home buyers were not. In 2012, the federal government launched a program that allowed corporations to easily purchase foreclosed homes by the thousands from Fannie Mae. The corporations that rented out the homes, creating more housing in areas heavily hit by foreclosures. Between 2011 and 2017, some of the world's largest hedge funds spent $1 billion on almost 250,000 homes. In parts of Atlanta, they bought almost 90% of the 7,500 homes sold between January of 2011 and June of 2012. Wall Street became the new landlord. Rather than protecting communities and making it easier for homeowners to restructure bad mortgages, the government facilitated the transfer of wealth from the American people to private equity firms. By 2016, 95% of the distressed mortgages on Fannie Mae and Freddie Mac's books were auctioned off to Wall Street investors. Wall Street's latest mass real estate grab has grown to tens of billions of dollars, representing hundreds of thousands of properties. In some communities, it has fundamentally altered the housing ecosystem, fueling a housing boom without a homeowner boom. Private equity firms have developed new ways to secure credit, enabling them to leverage their equity and acquire a nearly endless amount of homes. Wow. So a little bit longer. So I mean, what we see here is, and I know it does create some worries for those who are really paying attention to the housing market. Is if corporate America owns the majority of the homes in America, what's that going to do to the average citizen? Someone who's middle class, husband and a wife, have some decent jobs, 2.5 kids at home, a dog. So what is that going to how is that going to affect them if all of your options for living spaces are all owned by hedge funds and the like? So and then down the road, my thought is, well, what happens when, all these investment firms have all these, own all these properties, and let's say take a city like Atlanta in the article. Let's say something happens in the Atlanta area and business just dries up. Now these investment firms are holding the bag for a large swath of homes that it's going to be very hard for them to unload, especially if they own the entire block. I mean, they're going to be competing against themselves as far as selling all properties. So, I see this as being potentially a problem, but, it's a little early to tell. So we'll see where this goes. All right. Well, that is everything I had for the weekly update. I apologize for not getting it out yesterday, but I figure most people were and or shoot me an email. Hey, there I am. I'm back on the screen. So sorry if I disappeared for a second. And I'll have, I'm actually going to start doing some daily videos. I'm not sure exactly how that format's going to work out, but if you want to, I may send an opt-in email out to folks who want to get a reminder every day when I go live on that. So anyways, I'm still working on it. It's kind of a work in progress right now, but hope everyone has a terrific week, and I'll talk more definitely on Friday, and we'll go from there. Have a great one. Bye-bye.